what we're doing or what we've done, what we're doing today, and what the next several weeks have in store for us. So, we have looked at, in chapter 1, what is an estate, what is a trust, and everyone, again, gradually, some of these terms of art are sinking in, and we're going to be learning more terms of art, putting names to trust, and as early as week 2, for week 1, we learned the difference between revocable, irrevocable, GST trust, marital trust, minor's trust, all sorts of different labels, testamentary, inter vivos. It's a good working knowledge of what different trusts are. Obviously, our job is to figure out what are the income tax consequences associated with these trusts, not necessarily the names. But names are important. Names are identifications. Once you can identify what kind of trust something is, makes your life easier to figure out what are the tax consequences. An estate is an estate is an estate, so that's not too hard to put your finger on. Chapter 2, textbook, deals with issues pertaining to just how are trust and estates generally taxed, and truth be told, what similarities they share with individual taxpayers. Albeit there are differences. Code Section 180, for example, we have a compressed rate structure after 1986, and there's different ways when you have tax-exempt income and you have expenses, and you have to allocate that those expenses to the tax-exempt income because it's not deductible. We looked at Manufacturers Hanover and we saw that D&I does not include, when you do the computation, it does not include the denominator, does not include capital gains. Albeit in some instances it might, but capital gains are actually distributed. But we went through that whole process on page 55, 56. And we looked at other issues pertaining to trust and estates with respect to passive activity loss limitations and other issues that came up I just wrote in Journal of Taxation, came out in August, a new article about the application of Code Section 199A to subchapter J. And Code Section 199A deals with the deductibility in general, the 20% qualified business deduction, and how does it apply in the context of subchapter J. So if you're having trouble sleeping tonight or any night, go to the August issue of Journal of Taxation, and you can read an article which I co-authored with Alan Kornstein, who, if you didn't draw the connection, November 9th, I keep saying, I'm hoping to see one or more of you signed up for the August 9th event. Alan Kornstein is speaking on qualified opportunity zones, which are that and Code Section 199 are the two hottest topics in tax, I promise you. So if you can, make it your business.
Where is that seminar being held?
Right here. And you not only, you get to meet Alan, you get to meet, I'll be there, everyone will be there. Anyone in tax will be there. So, no excuses. You gonna be there, everybody? All right. Sign up, okay? And if you have a problem, let me know. And stick around for dinner. And then we have this person, and I don't know about you, you've heard me say this before, we're having the hypnotist. And I always am suspicious that these hypnotists bring in their own people and it's all just fun and games. So I'm hoping one of you volunteers and that I can see if this is reality or not. So
next time you need to bring somebody who actually can tell the future.
Tell the future. Who? Yeah. What was the? None of you, I presume, won the lottery, right? None of you are from South Carolina. All right. None of you. Did that person come forward yet? I didn't see.
No.
All right. So, but be someone here, keeping a low profile. All right. So we then turn our attention after chapter 2 to chapter 3. And in chapter 3, you you guys learn the landscape to this world called, the specialized world of subchapter J. And like I said, chapter 3 is encapsulated in large part, not entirely, in Schedule B of the Form 1041. By the way, I did speak to, and I keep telling you guys, I'm trying to work on this textbook because I think many of you will think our textbook's a little bit too dense for most students, and that we need a leaner, meaner textbook. So I'm working now with the gentleman who teaches at NYU. His name is Sean Weisbarn, and when he teaches this at NYU, just to let you know, they never ever look at a Form 1041. So I said to Sean that when we do this case book, I really think we have to have 5 or 6 examples like the ones I distributed to you, because I really think that students like yourself, and if you don't mind me saying as a professor, that it's so much use, like students to be able to see where this statutory language falls on a return. I think it's much easier to absorb. So I do think in this textbook, all chapters are written. Okay, just so you know, this is not just a dream of mine. The chapters are written. Sean is supposed to be reviewing them, and hopefully sometime in 2019, you can put your order in. You don't have to order yet, but sometime in 2019, we'll see if this book actually comes to fruition. The other thing
Specifically for subchapter J?
is for this course.
Okay.
For this course, because I know the co-authors of this book, and I know they're not doing a new edition, and I know it works. Okay, I think it works, but and a little foreshadowing. I plan if things fall into place. Let me just talk to you about what, and I'll give you a taste of where I think this is going to go. Is that so? Chapter 3, we learned about simple trusts, 651, 652. We learned about complex trusts and estates, 661, 662, and how there's a deduction for distributions up to D&I, the role of fiduciary accounting income, how to include income to beneficiaries, and what's the character of that income to the beneficiaries. And I will now spend a little bit of time reviewing what we covered in more detail last class. And here's how I see things playing out. Sean also told me at NYU, believe it or not, I found this a little strange myself. They have a whole 2-credit course on what? Aside from their subchapter J course, which you're in right now, NYU has a 2-credit course on grantor trust alone, all right? Which I thought was a little bit much, all right? I'm not so sure anyone would want to spend, I'm making this up, 30, 40 class hours just dealing with grantor trust. I mean, there's a place for it, but I don't know if you need to go in that much depth. So we are going to be spending tonight and probably the next 2 classes on grantor trusts. Just to give you an idea, this chapter 4 in our textbook is fairly lengthy, so be forewarned. Now, hopefully everyone's here got the email that I have to be a moderator at a tax panel in New Orleans. And I checked with V, and we have class next Wednesday, grantor trust, more grantor trust. And then we have class on Friday, a week from this Friday. Hopefully you got my email, and if there's a problem where you can't make it, V said she would videotape it, so I'll distribute it. If you can make it, those who made it last time we had a Friday class, we were able to have, I don't know if I want to call it a party, but we had a decent time, and I will supply dinner. If you guys can make it here, that'd be great. And we will spend that class probably in large part on grantor trust. And then, believe it or not, guys, time is not our friend here, because we'll have finished chapter 4. And I told you, chapter 5 of our book, it would be a complete waste, because no offense to these authors, nothing they speak of is relevant in the year 2018 in chapter 5. Nothing, zero. And chapter 6 deals with the issue of IRD, income with respect to decedent, which I mentioned last class, code section 691. And what I intend, and you guys are giving me an excuse to do this if I can, and I will see if I can just distribute my proposed chapter on charitable trust, because charitable trust is something that virtually all of you will come across in your practices. Code section 664, charitable remainder trust, charitable lead trust. So I will distribute that probably next week or send it by email as an attachment. And you guys can tell me what you think of my forthcoming book chapter on charitable trust, and it has problems, and we'll work through the problems together. And then the last class, we will work on IRD, because that's an important topic. And again, the book, our book, your textbook, is mediocre at best with dealing with that issue. So I'll distribute the proposed chapter I have on IRD. So look for it, okay? And don't read ahead. It's one of the few times I'll say to you, don't read ahead. Everyone good? You can read ahead to finish this chapter, meaning chapter 4. But don't read chapters 5 and 6. Because chapter 6 wouldn't be a bad idea, but there's a lot there, and it's really dense, and I think the chapter I put together on IRD is a lot easier to absorb, all right? So I'll be a little biased. You guys will have to be the judge, and if you think otherwise, you can let me know. All right, just tell it like it is. Does that sound like a game plan? So what I intend to do, guys, in the upcoming weeks and upcoming classes is that we will go through the entirety of chapter 4 dealing with grantor trust. And then we're going to introduce you to charitable trust and IRD. And I think if you get through all that, you and I will have done our jobs, because that really is the complete landscape, in my opinion, of subchapter J. And it gives you a good idea of all the trusts that are out there. And IRD is a topic that's ubiquitous, not just to trust and estates, but it comes up particularly with trust and estates. But it's an area of the law everyone here who practices tax should have a good command over. We're good? And if there's a problem, timing-wise or otherwise, let me know. Just bear in mind, I think, but you guys probably know this better than I do, I think our final exam is scheduled December 5th, or is that right, Karen?
That's 14th class.
Is it December 5th then?
Yeah.
Okay, so just bear that in mind. No, we do not, the one thing that you should bear in mind, the Wednesday before Thanksgiving, I know you guys are going to be disappointed, but we do not have class that night.
So we don't have class 2 weeks in a row then, right?
Right?
Right, and then
This
just
gives
the
you-
final class and then the exam, right?
Right.
Okay.
We'll give you plenty of time to catch up and master the material. All right?
Is the final exam cumulative?
It's cumulative, but more towards the second half of the semester. Very similar, Simone, to all my tests. Combination, multiple choice, true, false, and short answer. Again, I am not looking for the, if you should remember the midterm, I'm not looking for the minutia. I'm looking for you guys to make sure you have command of the general topics. Stuff that a week, a month, a year from now, you should all know. Before I begin, anything, again, Wednesday's classes are tough. Anything anyone did this past weekend worthwhile sharing with the class? I did see someone recommended Sean, the gentleman who I'm co-authoring this textbook with, said, oh, you're going to Japan, you got to see Lost in Translation with Bill Murray and Scarlett Johansson. That was an interesting movie. It got great reviews.
I didn't love it either.
I didn't get it.
I mean, yeah, it was just like, it was just very slow and like, what?
Slow, and I keep
happening?
waiting for something to
Yeah,
happen.
happening, yeah.
And he's way too old and she's way too young for him, so I don't get the chemistry there.
Yeah, I mean.
I didn't get it. Just went right over my head. I did something that everyone in this room, if you haven't done on Sunday, you're really doing yourself a disservice, you're doing your significant other a disservice. I had brunch at Grounds for Sculpture. You don't have to have brunch there, but you have to go to Grounds for Sculpture. It's in Hamilton, New Jersey. It is truly one of New Jersey's
Oh, I've been
jewels.
there.
What's it?
I've been there.
You've been
I
there.
did brunch there. Yes.
At Rats is the name of the restaurant.
Yes. Yes. I've been there.
Simone, have you been there?
Can you repeat the place?
Yeah, it's really nice. Yes.
It's beyond nice. I mean, it really, if you don't go, it's
Yeah.
like, I can't say it otherwise. I mean, Shane, you haven't been? Grounds for Sculpture.
Grounds for
Sculpture.
Yeah.
Put it on your to-do list. Shane, I don't know if you're dating anyone, not dating anyone, married, not. You want to win some brownie points? Go.
It's
Okay?
great for some crazy pictures.
JJ owners started it, yes? JJ.
Johnson, one of the sons of Johnson & Johnson, discovered himself there.
Ah, so he actually.
He donated big money there, and he's a sculptor, right?
Brunch is just okay. I wouldn't do the
Yeah,
brunch there again.
it's pricey, but I'm saying go for the art. I didn't say you have to go for the
right.
food.
Yeah.
Yeah, no, you've gone or not gone?
I went to another place in Livingston for brunch on Sunday morning with my friends.
You went to Livingston, what?
For brunch on Sunday morning.
Okay, what's the name of the place?
It's a Sweet Basil Cafe. It was really nice.
Yeah, I hear it. Sweet basil is supposed to be very good.
It was
Any-
very crowded, but it only takes like rough 10 minutes. You will get a seat. But
Okay.
I'm surprised it was very crowded.
Gotcha. Anyone else do anything or see anything?
I actually went to brunch too on Sunday. It's funny because we went to this Hoboken house tour. My sister and I took our niece, and we went to, I haven't been to brunch in ages. We went to City Bistro, which was awesome because
I live right there.
Huevos Rancheros was fantastic, and $4 mimosas, and you can have her make it like right in front of you, so you get the 90-10 champagne orange juice combo. I can't stand when you get a mimosa and it's like a splash of champagne from the glass of orange juice.
I can see City
And they're
Bistro from my
$4. It
bedroom.
used to be $3, and then it's $4. Usually you go to the city, they're like $12. Yeah. But anyway, and then the house tour was very nice too. 'Cause I guess a lot of these brownstones are they converted into 3 apartments. Now people are putting them back to single family homes. I don't know how much money that costs, way more than I make, but wow, some of them are just so nice. They're really well, had designers do it and all that. It's like, so it's jealous.
All right. Put these things out. Dane, you haven't done anything?
No.
All right, gotta get you out of the house. Okay? All right, guys, let's just remember some of the things we covered last class, and let's get into some of the new material into grantor trust. So, I just want to emphasize, because you could get, on one hand, if you never took this course, and you only took income tax, you might think to yourself, well, I learned that generally the receipt of a gift of request isn't subject to tax, and I learned, you knew that under Code Section 102, right? Gift request. And then all of a sudden, you have Code Section, all the code sections we looked at, where distributions from trusts and estates fly in the face of that, right? Because we said that generally distributions pull out D&I, and that the recipient would be issued a K-1. So you're juxtapositioning these alternate universes, and they don't seem to make sense. Which I have to say, parenthetically, if you haven't seen it, I see now it's on TV, but I thought it was a great, really good movie. 10 Clover Street. Have you guys seen that one? It was released in 2016. 10 Clover Street. It's about a guy and a woman, and they're stuck underground, and the question is there an apocalypse hell outside, or is he just keeping her under lock and chain because he's a guy, he hasn't joined the Me Too movement, kind of thing. So it's an interesting movie if you haven't. 10 Clover Street. I just, on the treadmill, I saw it's now on TV. All right, so how did my brain go there? Juxtaposition of two worlds. See, in that movie, the woman who's captured underneath doesn't know which world is the real world. If he's lying to her, or if there's really this apocalypse going outside. So here, I know you're thinking, how does his brain work? I'm just saying the juxtaposition of 102 versus D&I, but the savior of the day is Code Section 663, right? Which says that, or it's an affirmation that Code Section 102 is alive and well, right? That if there is a specific bequest and money comes out of an estate, or there's a specific sum of money coming out of a trust, right? That does not trigger or does not pull out D&I, right? Everyone's with that? Okay, so I just don't forget for exam purposes, or if you're working with a trust or an estate, that Code Section 663 is an affirmation of Code Section 102. I thought the examples under the regulations under 663 are very useful, so if you can, please take a look at them. Trapping distributions we spoke about last class, and we said in yesteryear, Javier, you weren't here, I think you were in here.
Yeah.
Meg, do you remember why are trapping distributions no longer popular? They used to be. Why aren't they anymore? Remember?
I just remember how to put the trapping trust between the, yeah.
Why would people want to trap?
It's for the
Lower tax rate, right? People wanted to exploit the lower tax rate, right? And if you trapped income in a trust, the idea was to trap income in a trust level so you could avail yourself of the lower trust, lower tax rates. So you would have an estate pour income into the trust, and because the income was considered what? Principal, right? Under the Principal and Income Act, right? The Principal and Income Act said these distributions from an estate into the trust were principal. The Principal and Income Act applied, and therefore it was trapped, because even though it constituted income for income tax purposes, right? Constituted income for income tax purposes, it was considered principal under the Principal and Income Act. So the beneficiary, if I could pound my fist, couldn't pound, the trust beneficiary couldn't pound and say, I deserve that income, right? It was considered principal. So the monies got trapped at the trust level, and they were subject to tax there. In the year 2018, that's not such a hot idea, because that just means they're going to be subject to high tax rates, right? So trapping distributions have shed their popularity. And I don't mind that the authors spent a little bit of time talking about trapping distributions, but it's not a strategy that people subscribe to anymore, okay? So if you hear people talking about trapping distributions, it may be because they're unhappy. And I said one of the biggest instances of a so-called trapping distribution, and this one happens with some frequency, is that people make their IRA money payable to trust, okay? I had this come up early in my practice. Picture, if you will, decedent dies, has $1 million IRA payable to his trust, okay? He has, just to keep the facts simple here, suppose he has one son, but the son is a spendthrift and would just burn through the $1 million. So dad wants it to be paid to a trust so the trustee can monitor the payment of these funds, right? So the $1 million gets paid into the trust. What does it constitute? Income, right? Everybody agree? It's IRD under Code Section 691. So the $1 million gets paid into the trust, but does the trust distribute it out to the son who is entitled to all the income from the trust? Okay?
I'm just thinking already, a Roth IRA is also IRA.
Well, Roth IRA is an IRA, but it's not taxable, right?
Yeah.
So I don't know if that's a good example. Most IRAs are not Roth IRAs. So if you have $1 million going into the trust, right, it's going to be issued a, what is it, a 1099-R?
Yes, I guess, yeah.
It would be, the trust would be issued a 1099-R. Everyone agree? Does it remain taxable to the trust, or can the son pound his fist on the table and demand the money.
You can't because it's a trust corpus.
It's considered principal.
Oh, yeah.
All right, so everyone see it gets trapped. B, you were gonna say.
No, blue light gone.
I'm sorry? Oh, blue light gone. Wow.
Just trying to get the visual, so the IRA, the beneficiary of the IRA is the trust, that's established.
The
before.
beneficiary of the IRA is the trust, yes.
Okay, and then they're making a withdrawal.
Who is they? Be careful of your pronouns.
The trustee is making,
I don't know if the trustee, let's say the $1 million goes in on January 1st, right? Dad dies, and it takes a few months for the money to get transferred, right? From the IRA to the trust. And you're the trustee, Simone. I die, and Dane, you're my son, okay? So, I distribute the $1 million to Simone. She puts it in the trust account. She's got the EIN number. The bank's gonna issue you a 1099, Simone. You're gonna have to pay tax on that $1 million. And just say by the end of the year, you get 55% return on the $1 million or 50,000. Dane will demand 50,000, right? Everyone agree? And your tax liability will start off, I'm oversimplifying, $1,050,000. Everyone agree? The $1 million from the IRA plus the $50,000 of income that was internally generated, right?
So you have to pay the moment it gets to the trust this year on the entire
Truth?
amount.
You want me to be complicated? I'll be complicated.
Yeah, always.
Under 401A4 of the code, estates have essentially, if there's no so-called designated beneficiary, and an estate is not a designated beneficiary, a trust, excuse me, it would be 5 years. It has five, it could actually pay out over 5 years.
I've heard about it.
Okay?
I've heard about it, but.
Yeah, there's a 5-year payout requirement. But let me just keep it simple because,
Yeah, yeah.
right, so Simone gets $1 million, earns 50,000. Dane pounds his fist on the desk. The only thing, Dane, you can get is 50,000. The 50,000. Now D&I starts. What's the D&I in that trust? Aaron,
50.
isn't it 1,050,000 because D&I starts off at all income, but you're taxed on the lesser of the income or fiduciary accounting income, right?
Wouldn't
So-
you tax if you got stuck with $1 million all at once, then you'd be in the highest tax bracket where people normally just.
Fine,
take
be careful of
IRA
he.
distribution.
Who's he?
Or if somebody just didn't die and just started taking distributions from their IRA when they retire at 70, usually you'd be in a lower tax bracket because you wouldn't pull the whole thing out, right?
Absolutely.
Yeah, I mean-
And that's why most people want to have a designated beneficiary, and it gets more complicated because if there's one beneficiary, Dane's life under something called the universal table, you can have a stretch IRA and pull it over Dane's extra lifespan. I just want to talk to you in general about so-called trapping distributions where monies can, depending on the circumstances, be trapped even in 2018, not intentionally. In yesteryear, this was intentionally done, right, guys? People wanted the trap was a good trap. Now, it can happen, and you gotta be cognizant because I even tell you, and I'm guilty of this when I first started practice, so I can tell you, I like to think if it happened to me, it can happen to anyone, is that before I really started honing in on Subchapter J, in my case, there was $100,000 of the IRA. It wasn't a big number. It was being paid in, and the terms of the trust required that all the income be paid out. So I said, oh, the beneficiary gets $100,000. There's a lot more going on. So I was under an illusion that I just ignored completely the Principal and Income Act. And the beneficiary was the benefactor of my idiocy. But putting that issue aside, I've learned since then I was dead wrong. But there's a lot of people out there, my former self, who walk around thinking, oh, it's income, and the beneficiary has the right to income, and they don't distinguish between income for income tax purposes and income under the Principal and Income Act. All right? So I've been there, done that. I hope I'm not going to make that mistake again. You shouldn't. But a lot of your brethren practitioners will make the mistake I did of my younger self. All right? I didn't have myself to teach myself. I have you guys now can take my mistake and learn from it, okay? All right, so trapping distributions we spoke about. We spoke about terminations, okay? We spoke about the fact that, again, in yesteryear, did you want to terminate or not terminate an estate? You want to keep it open, right? Keep it open as long as possible, right? Because again, you can take advantage of the lower brackets. And it was the IRS that used to bring these actions, but you can anticipate in the year 2018 and going forward, we're not going to see a single case on this. The IRS has no incentive to cause you to accelerate a trust, terminate a trust or terminate an estate, because generally, as you guys know, the income earned is going to be subject to the highest tax rate. So we're not going to see these cases anymore, guys. All right, then we turn ourselves, our attention to Code Section 642H, D and H. Just to remind ourselves.
I have one note that I didn't finish. I said state tax return must be filed 9 months after, and then I have a blank.
All right. The state tax return must be filed, it's true.
9 months after.
Date of death. Date of death.
Date of death, okay, sorry.
And you can get up to a 6-month extension, just so you know.
Oh, okay.
Now, just call to your attention that we already said that generally, unlike partnerships and S corporations in which losses flow through, everyone agree? That in a partnership or an S corporation, losses flow through. That is the antithesis of what happens with a C corporation, right? A C corporation never, ever passes through losses or deductions. Agreed? Agreed. Once again, trust and estates occupy this unique vantage point, spelled out in Code Section 642H. That says that at least on termination, it's the only time this can happen, net operating losses can pass through, or in the last year, if there's excess deductions, they can pass through. The only problem with the latter, at least for the time being, is these excess deductions constitute miscellaneous itemized deductions, and under Code Section 67G, miscellaneous itemized deductions are disallowed until the year 2026. Right? And we went through, with respect to excess deductions, who is a beneficiary? Because only if you're a beneficiary of the trust or estate are you entitled to get those deductions. And you can't purchase it. You can't be a purchaser. That's the first case. And we looked at permutations of this. And remember, when you compute excess deductions under the O'Brien case, you do not take into account the charitable deduction. So when you take into account or compute the excess deduction, the IRS prevail, that's on page 225. The footnote 3 shows you this simple computation, as opposed to the taxpayer's computation, in which the charitable deduction, the taxpayer sought to incorporate the charitable deduction. On page 230, we began a discussion about distributions in which gain must be recognized. Now, let me just say this, is that we've looked, at least in the income tax class, and I periodically mention the Keenan case. Keenan is a well-known, well-recognized case, and it stands for a simple proposition. And you guys who've had me for income tax know this proposition. That if there is a specific dollar amount that any of you in this room owe, you owe a debt to someone, and you satisfy that debt with appreciated property or lost property, that's going to constitute a sale or exchange. So if I owe V $1 million and I pay V with Apple stock worth $1 million, but my basis is $100,000, I'm going to have a $900,000 recognition of it. And I'm going to have a $900,000 capital gain. If I pay V with the inventory I own, okay, I was a real estate broker and I had lots of real estate, and my real estate was my inventory, and I paid V with $1 million worth of inventory, that would give rise to $900,000 of ordinary income, right? It would depend on the type of property I used to satisfy that obligation. In this case, the trustee was obligated to pay a beneficiary $5 million, and they used appreciated property to satisfy that obligation. And in this case, this was the Second Circuit case, 1940. It held that it resulted in taxable gain.
For the estate.
I'm sorry?
For the estate.
For the estate. I think, wasn't it a trust? You got it?
This is being, okay.
Yeah, I guess it was out there for several years, so, yeah, it was for a trust. Let's put it this way. Alicia, it's universal, whether it's an estate or trust. What is that?
That doesn't matter, because she put her residual estate into trust. Doesn't matter who pays the tax?
Well, will, because I mean, again, it's always a question. In this case, we're gonna talk about, in this case, it's a satisfaction of a debt. What we will see that normally, when you make distributions of property, appreciated property, just let's keep it simple. Suppose in the fact pattern, I was the trustee and I distributed Apple stock to V, and the trust had invested in Apple stock when it was worth $100, and now it's worth $1,000. Okay, everybody have that? Solid buys Apple stock for $100, it's now worth $1,000, and I make a distribution to V because I'm the guy turning on and off the spigot. I was entrusted by, someone gave me money to hold in trust for V's benefit, and I give her the Apple stock, okay? How much is she taxed on? Assuming the trust has, make up a number, 500,000 of D&I. So it's got plenty of D&I. Now I give V the Apple stock with a basis of 100, fair market value of 1,000. David, what do you think? What's V taxed on? Any thoughts?
She, capital gain, I don't know.
That's not the question. It's a number. Ping, you were gonna say?
It's a nine. The cost should be the carryover and then.
What will
is
she
it?
be taxed on? V be taxed on.
The gain, capital gain, which is based
Hold on,
on.
hold on. I had no, you're forgetting a very important fact. I did this out of my goodwill, meaning I just thought V needed $1,000. I had no obligation to give it to her. In Keenan, there was an obligation to give her $5 million. Sola just gave V the money because I just thought it was a nice day outside, and I had absolute discretion to give V assets whenever I chose.
So it's a gift.
Entire,
Well, it's not a gift, because
entire amount.
in the context of a trust, In the context, I'm not giving her a gift. Like if I were her father or child or husband, I could give me a gift, but as a trustee, I can make a distribution. And because it would not qualify under Code Section 663, because 663 says it's a specific dollar amount, and I could have given her $500, I could have given her $3 million. I chose to give her one share of Apple stock worth $1,000, in which I had purchased it several years ago with a basis of $100. I purchased it for $100, it's now worth $1,000. Everyone get that? I'm the trustee, I have absolute discretion. I feel powerful in this role. I am. I can turn on and off the spigot. And that's often the case with a trustee, right?
So then it pulls out the DNI, you said, right?
So my question is, what does V get taxed on?
1,000.
Well, give me a number.
1,000.
Is she the beneficiary?
She's absolutely beneficiary because I wouldn't want to violate my fiduciary duties. I want to give it to you. I don't need that badly. But you're not being just the beneficiary.
Oh, then it'll
She
be
is.
the $900.
No,
Why 900?
you said there's enough of DNI.
He said there's.
I said the trust has $5 million of DNI,
So
and I'm
then
just
it's-
making this
So then
distribution.
it's $1,000.
How much?
1,000,
No, but
right?
I hear 100, I hear 1,000.
No, I should get taxed on 1,000. I'm the beneficiary.
Worth 1,000.
Yeah, there's enough DNI to cover it, so.
Shane, are you going to stand by and let this happen?
Since code section, I happen to know that code section is 643E, that unless.
Let's look at it together. Because we know, don't we, where do all answers rest? But the code. So we have to figure out 643E1 and 2. And even though the authors downplay this, obviously, David, this is important, right? King, important. E1 says, what's V's basis? The basis of any property received by a beneficiary in a distribution room in the estate of trust shall be the adjusted basis in the hands of the estate of trust immediately before, adjusted for any gain or loss. But when I make a distribution, unless paying it's a specific dollar amount, unless it's a Keenan gain, there's going to be no gain or loss, right? Generally, when you make distributions from an estate or trust, is there gain or loss, guys? In general. No. Two-letter word. No. All right? Ping, you've got this strange look on you.
Is that a gain loss claimed by trust or claimed by?
Oh, it's claimed by no one. There is none.
None.
In other words, I make a distribution, and by the way, no offense to B, if I was going to be the trustee and there was going to be a gain, I might not make that distribution, right? In other words, I don't think Congress wants to get in the way of having the trustee make distributions because it would be an impediment, right? If we were going to accelerate the tax effect. So there is no, generally when trusts make distributions, it does not trigger gain or loss regarding the appreciated property. Everyone agree?
so V's.
And by the way, can I just make one observation? This is an important one. I'm not going to test you on this, but with respect to corporations, C corporations or S corporations, is what I just said true by way of contrast? I just want to call to your attention, one of the most important code sections in the realm of corporate tax is code section 311. 311 says that if you make a distribution of property out of the corporation, all gains are recognized, no losses recognized, okay? That's one of the biggest code sections of all of subchapter, and that extends to S corporations, okay? Anytime you make distributions from a C or an S, losses are disallowed, surprise, surprise, but gains are recognized. That same rule does not apply in the realm of trust, right? There's no rule 311. And so in other words, we can make distributions left, right, and in between. The only reason Keenan applies is it's a different kind of fact pattern. There was a debt owed to a beneficiary. And that's what triggered it. When the trustee makes discretionary distributions, there's no debt. And those distributions just get paid out to the beneficiary, and it does not trigger gain or loss. And V's basis in the Apple stock will be $100. Everyone agree? And to close the circle here, because I know you're at the edge of your chairs wondering, look at code section 643E2. What is the amount that V has to take into income? In the case of any distribution of property other than cash, the amount taken into income under 661A2 or 662A2 shall be the lesser of the basis of such property in the hands of the beneficiary or its fair market value.
So it's
Should-
zero.
Hmm?
So there's zero income.
Why? What's the lesser? Give me those two numbers,
Lesser
babe.
is 100.
So why did you just say zero?
I mean, so
You
the
said
income
base.
reportable is zero.
Why? Isn't your income 100?
That will be adjusted basis.
My income is 100?
Yeah.
Yes, income is 100.
It says your income shall be the lesser of 100 or 1,000. Last I checked, 100 is the lesser of those two numbers, right? And you'll pull out 100 in
I
the
don't like
DNI.
that.
What?
I want it to be fair market value.
No, you don't. Why do you want to
I
get
mean, yeah, I mean, I know in a real situation, I wouldn't want it to be fair market value, but wouldn't it?
But B, when you go to sell it, you'll recognize the $900 difference.
Yeah, I'll tell you something.
Oh.
So you have $100,000. You put it to the trust, and then it makes money, so you pay taxes, and then you need to take the money back to pay for your son's college. So, but
So property is just,
only when you sell the stock,
right,
then when you
right,
pay the
then
taxes.
it's not realized
Not
yet,
when you
okay.
take it back from the trust.
Right.
You know?
What's
Like
that?
I don't know, Alicia, I don't know if I like your example of the
Yeah,
trust.
because in the
But-
meantime, the stock needs to appreciate in value. Like you put $100,000, and 5 years later you have $200,000. You take it back, but you pay taxes only when you sell the stock. Is it? Do I understand it correctly?
Well, if you don't mind, I'm going to wipe aside
Okay.
your trust, because I think that's misleading on several different
Okay.
levels. But in my very simple example, which is a realistic one, if you don't mind me saying, is that if we set up this trust for V, and I'm the trustee, and I decide today is Wednesday, and that V should get this $100,000 or $1,000 to use my example of Apple stock, and my basis in that stock is 100, is the code under code section 643. E1 says her basis is 100, and E2 says she will pick up $100 worth of income. Or it doesn't say she'll pick up $100 of income. Truth be told, E2 says that's what's treated as being distributed, and it leaves it up to the rules of 661 and 662 to decide how much income she has. Why? Because if the trust only had $20 of D&I, V will not be taxed on $100. She'll only be taxed on 20. So it's incorrect to say 642E2 dictates how much income she has. It's just telegraphing how much is treated as being distributed. David?
So her basis in the stock is $100. Even though
Yes.
fair market value is 1,000.
Yes.
Okay, and then she picks up $100 on
Under K1.
her K1.
Yeah.
And the nature of the $100 is capital gain, or is it
It really depends on the character of D&I.
ordinary income? Or?
Depends on the D&I, the character of D&I.
Okay.
I need to know. What is the D&I? Okay?
So then there's no reason to ever make that election to take fair market value.
And code section 643E3 says a trustee can elect to recognize the gain.
Trustee can elect.
Yes.
Oh, I thought it was the beneficiary.
No, the trustee can elect to recognize that gain, and if that were the case, trustee has a $900 gain, and then V would be taxable on 1,000, and it would be treated as if $1,000 was being distributed to her.
We have a few of these examples to go through.
Yep, we're about to do those.
But, okay, so before it came to the trust, It's just taken at the
Right.
same basis?
Just be careful, because now we're getting into Alicia's world,
Okay.
which is, I'm not sure what it
I'm
means.
thinking real life.
Yeah, let's get into the real world. What do you mean before it gets into the trust?
So, okay, so let's say, you're the trustee, I'm the beneficiary, and let's say David created the trust.
Okay, David gave me
Then
$1 million and I invested in Apple stock among other things.
10 years
Oh,
ago.
you invested, I was thinking David gave you the Apple stock already. What
Well,
if,
he could have.
Maybe he could have, yeah.
yeah, okay, so he could have given you, let's say, that at that time that he gave you the Apple
He
stock.
could have, everyone agreed, he could have given me the Apple stock or he could have given me cash and Solid decided Apple stock is the way I want to go.
Right, but if he gave you, let's say, Apple stock, then does it transfer from him to the trust
Yeah, code section 1015.
at what value?
Well, that's immaterial because code section 1015 says he made a gift, obviously, to the trust. And code section 1015 says the trust has a carryover basis.
So it carries over to the trust, and then
Right.
carries over to me.
No.
Well, it does, with,
Okay.
okay, if I decide to distribute it. But again, a lot of things can happen in between. I could sell the stock David gave me. I mean, I have a fiduciary obligation to diversify my portfolio. Whatever David gives me, no offense to you, David, I mean, I have my neck's on the line. Once David gives it to me, I can't blame David for poor investment choices, right? That's my role as trustee. So I may do certain things with this and invest in new stock or reduce it to cash. I mean, we can go through 100 different scenarios.
I guess you don't understand her question.
Yeah, I'm
Yeah,
still
yeah.
struggling to figure out why do I recognize $100 as
Well,
income?
All it's saying is what's being distributed is considered $100. We're going to go through some examples.
Right,
So
right.
hold that
Because
thought.
then that sounds like principle. If it's at the carryover basis, then
Yeah,
that sounds like
but
principle to me.
Otherwise, trustees could be strategic in what they distribute. And they could say, gee, I'll distribute stock because that's principal and she won't be taxed on it. Or I could distribute cash and that will pull out D&I. And the whole 1954, post-1954 regime stayed far away from that whole approach and just said, look, whatever comes out pulls out D&I. And the only question is, in this case where Apple stock is being distributed, should the amount of D&I be pulled out equal $100 or should it equal 1,000? And what Congress decided, you guys can read Code Section 642 for yourself, Congress decided it should be $100. It's a
You need
point,
to defer the 900 until you sell it.
yeah,
Okay.
there's no leakage here. Everyone agree? Nothing's being leaked.
I guess what could have happened to avoid like the middle man, which is the trust, is that they could have just gifted that Apple stock directly to the,
Absolutely, but I don't trust me.
oh,
So that's why we didn't give it directly to her, right? That's why trusts are used all the time. Or for tax reasons, but for whatever reason. Right? She's my spouse, she's gonna get remarried, so I don't want that, that money to go into H2.
Nice name.
H2.
Don't you have names for your replacements? I thought that was part of every marriage, you have to have a name for your replacement. when
Is
you're
that
not-
your replacement name?
My
H2?
replacement's called H2. I keep on wanting to,
W2?
I have to.
And you
I-
have W2?
Is there a W-2?
That's
There's
funny.
always a W2 too. And I'm always trying to do H2. He doesn't even exist yet, but I'm still trying to outdo him. All right. So, anyway, that was a long, I hope, worthwhile digression to Ping, in this case, looking at the Keenan case. And the material that follows, again, if I were writing the textbook, and I guess I am, but we'll see if mine actually gets printed, so the jury's still out on that, is there's a series of revenue rulings that the authors offer. about different fact patterns, whether or not they'll give rise to, it's really known as Keenan-like gain. Okay, Keenan-like gain. And there's a revenue ruling 67-74. And suppose I just keep my fact pattern simple again, is that David gave me $1 million of cash. I'm the trustee, and it earns $50,000 of income, and the terms of the trust say he gets all the income from the trust, okay? Everyone have that? David contributes $1 million of cash. I invested, I generate income of $50,000. I owe V $50,000. And I'm gonna pay V $50,000, but I don't wanna pay her cash. For whatever reason, I decide I'm gonna pay her in appreciated securities, right? Is that considered a debt? Like, if I pay her with $50,000 of Apple stock, that I have a tax basis of $10,000, will that give rise to a $40,000 gain? What does this revenue ruling say? Yes. That if I have an obligation to pay income, as it becomes a fixed obligation, and I pay her using appreciated property, that income, that's going to be considered a taxable event. Second line from the end of the case. It's like 4 or 5 lines up from in that revenue ruling. It says the instant transfer involving stock having a fair market value equal to the trust income for the year in question, which the trustee was required to distribute to the beneficiary, resulted in a capital gain to the trust equal to the difference between the basis of the stock in the hands of the trustee and the amount of the obligation satisfied by the transfer. That's just what I said. Where I had to pay V $50,000 and I used appreciated property to satisfy my obligation as trustee. Suppose, under the terms of a will, someone is supposed to be paid, Young Hung is supposed to be paid $250, okay, under the terms of a will, but the only item left is appreciated property worth $200 with a basis of $150. So we can't even give Young Hung, under the terms of the will, EK, sorry you died, and EK says Young Hung should get $250, but EK's estate only has $200, okay? So Young Hung is going to get the entirety of EK's estate, okay? But it's not going to be enough. But the question is, will EK's estate nevertheless have a $50 gain, right? The difference between 200 less the basis of 150. What does this revenue ruling say? It says yes. It will recognize $50 worth of gain.
Yeah, but in this case, then, you wouldn't have any money to pay the tax on.
Well,
All you had left was those shares after everything
you know
else was
what?
done.
When Young Hung got the money, she would have to transfer your liability. She would probably owe the money. Because, yes, you're right, the estate has nothing more, but it's an estate obligation. So the IRS could probably go after, I think can go after.
So she can apply 50
I'm sorry?
as deduction against her income.
I'm sorry, Megan, say it loudly.
Because she got 200.
She
And
get,
actually is 250, but not enough.
no, she only got 200.
Only 200. So the 50, she can apply 50 as a deduction.
No.
No.
She died in an EK, and I'm the executor of her estate. And this revenue ruling says, when I give Young Hung stock worth 200 with a basis of 150 on the form 1041 that I have to file for her estate, I have to report a $50 gain. That's all it's saying. I have to report the gain. And since this is a specific bequest under Code Section 663, it really, theoretically, it should not carry out any income to the beneficiary. Okay, this is a specific bequest, so it's not a residuating bequest would pull out D&I. This is a specific bequest. It falls within the scope of Code Section 663. On page 236, taxpayer B got stock during his life worth $200,000 or $200, whatever the number is. And the taxpayer, under the taxpayer's will, has what's called an equalization clause. It says, whatever I gave to B, taxpayer B, I want the same amount to go to taxpayer C. Okay, we're gonna have a visual where I'm gonna die, but during life I gave Alicia $200, and now, under the terms of my will, I want Edward to get the same amount. Okay? Everyone got that? During my life, I gave Alicia $200, and I want to be fair to Edward. I want to give him $200. Okay? And that's an equalization clause, meaning, and that's supposed to be a specific dollar amount because we know what I gave Alicia. Everyone agree? The only problem is, when I die, there's only $180 in my estate. Once again, not the full amount. Having said that, if that $180 is appreciated, will that give rise to gain? And the answer is yes. Very similar to what we just looked at. I don't want to get too, like for exam purposes, just be able to identify what is a specific bequest and the satisfaction, right, will give rise to potentially gain or loss. Now just bear in mind, you guys have seen this before. Congress never has a problem with gain, right? What do we know about losses between related parties?
Section 267.
Right. Code Section 267 often puts the brakes. And if you look, if you can, open up to Code Section 267. If you look, 267A disallows deductions or losses between related parties. That's 267A1. And what is the relationship? Look at B. Look at B6. A fiduciary of a trust and a beneficiary of a trust, right? So if you have a loss between a trust and a beneficiary, that loss is going to be disallowed, right? And if you look at B13, this is a relatively new addition, except in the case of a sale or exchange in satisfaction of a pecuniary bequest, an executor of an estate and a beneficiary of such estate. Not surprisingly, again, related parties, deemed to be related parties.
What was the other code?
267B6. So, I don't want to belabor this. You guys can read the material. I do want to try to do before the break, because it's important, are the problems. Let's look on page 242 at 3-27. Okay, everyone read that to yourself. It's not the most artful problem, I have to say. It's a little bit hard to read. I did a little chart in my book. Hopefully it's helpful. In the year in which an estate has D&I, none of which is tax exempt to $20,000, distributes $5,000 of cash to a beneficiary who received a $5,000. I don't know why they refer to it as a general bequest. To me,
As opposed to pecuniary, is
a
it?
specific bequest, usually under the terms of a will, I'll say someone, so-and-so, Joe Smith, I give, devise, and bequeath the sum of $5,000. And I've always referred to that as a specific bequest. So I don't know what a general bequest is. So let's just say it's a bequest of $5,000 under the decedent's will, and $5,000 cash, securities then worth $10,000, and real estate worth $15,000 to the residuary beneficiary. Okay, so the residuary beneficiary is getting these three things. Under local law, title to the real estate passed directly from the decedent to the residuary beneficiary. So what that means is, guys, it's not part of the decedent's probate estate. It was held presumably jointly with the father and the son held the real estate jointly. However, the executor is entitled to possession of such property during administration. That's all. I mean, I can't, just local law permits the executor to make sure that the land is protected, but it's not part of the probate estate. The executor's basis in the securities is $4,000, the basis in the real estate is $12,000. So I just put together in my book a little chart that the securities, real estate, and we're going to see there's going to be a car that's going to be introduced in one of the problems. So let's just spell it out here. That the adjusted basis of the securities is 4. Its fair market value is 10. Real estate 12. Fair market value of 15. Let's pause right there for a moment. We'll get to the car in a moment. So the basis is 16. The fair market value is 25. Okay? We didn't get to the car yet, so let's just pause there. Okay. Calculate the amount subject to taxation under 662 in the hands of each beneficiary.
Each?
Well, there's a beneficiary who's getting $5,000, right? Specific bequest. Let's say Shang, and Dane's going to get the residuary estate. Okay, everyone have the visual? Shang's getting $5,000, and Dane's going to get the residuary estate. How much is each one? Come up with a number each one should be taxed on. Okay. Shang gets taxed on how much, guys? Shang, how much you get taxed on?
So 5,000.
You agree or not, EK?
I cannot.
You do not agree. Why not? Just say loudly.
$5,000 is specific amount.
5,000 is, so what code section shields you from tax? 663, right, Shane? You get a $5,000 specific bequest, you shouldn't be taxed. complements of 102 and 663, right? Don't make that mistake on the exam, don't make it in practice.
So it's a gift, right?
Well, it's bequest.
It's a bequest, so it's not taxable.
Dane, how much does Dane get taxed on? Dane?
Is it the 16?
Hey, why do you say 16?
I was thinking the justice basis for the securities and the real estate.
All right, let's pause for a second. The real estate is not part of the probate estate, right? The real estate is just going to you because you were joint, it was joint, so it's not part of the probate estate. So it's not considered being distributed from the estate, right? Everyone agree? The authors made clear, it's a little bit oblique, that the real estate is not part of the estate here. Everyone agree? It is not part of the estate. So you will get that real estate. What will be your basis in that property? Don't overcomplicate it. You're just getting it because the person presumably died. It took a while to distribute it. Code section 1014 presumably applied, right? The person dies, basis equal to fair market value. So it's probably worth 12 when the person died. It took 9 months to distribute to you, and it just went up in value. So you're just going to take over this real estate with a basis of 12 worth 15. Everyone agree? It's not part of the estate. It's not ever going to show up on the Form 1041. Everyone agree? The executor really had no control over the property. By way of contrast, go ahead.
So, because it's outside the estate, it's passed on to the.
It's passed on automatically.
Right, and then there's no step up, or?
I told you, there is.
There is a step up.
But we're going to presume that it got stepped up at death to 12, and then it took several months or a year to distribute
and
up
then
to.
it appreciated to 15?
Exactly.
Right,
Which could happen.
okay.
Me? What's the problem?
We said that the basis is stepped up, but no one recognizes gain? Unless
No,
it's
that
not
code
realized.
section 1014 happens all
Right,
the time.
right.
Big leakage to the
Yes,
code.
yeah, okay.
So what is Dean going to be taxed on?
4.
Dollar-wise, guys? How much is Dean going to be taxed on?
Is he the beneficiary
Yeah.
or the
He is the
residual?
beneficiary.
He's-
Dean, how much are you going to be taxed on?
Would it just be the 4,000 for the securities?
What else did you get? You got to read the problem a little bit more closely. What is Dean getting from the estate? Isn't he getting?
5,000 cash.
You're getting cash of 5,000 and the securities.
That's not a specific request.
No.
Okay.
Shannon got a specific request. You just got whatever else was left in the estate.
Got it.
So, Dane, how much you gonna be taxed on?
So 9,000.
9,000. What's our authority for that? A few things. We know the D&I here is 20, right? Everyone agree? And therefore, he's gonna be taxed on the 5,000 cash plus the 4,000. What's the authority for the 4,000? V will appreciate this. Code section 643E2, right? That's the amount deemed distributed, the adjusted basis, not the fair market value, because the adjusted basis is less than the fair market value. So the 4 is deemed the amount distributed. You can picture, can't you, a few multiple choice questions on this? Karen's shaking vigorously, yes? And you can see this come up in practice, right, Karen? Yes.
Okay, so this, right, just to make it clear, so if he was an income beneficiary, not a residuary, then it would be taxed on this, then it, okay, never mind. Then it, oh, no, then the trust gets has to take the gain.
Think about it, we'll come back to it.
Okay, yeah.
The bottom line is Dean gets taxed at 9,000. What code section, Dean, taxes you on 9,000? Truth be told, What code section? 662, right? In other words, an estate is deemed to be a complex trust, everyone agree? And the estate is making this distribution, and therefore, Dane, it gets a distribution deduction under code section 661, but Dane has to pick up the income for this distribution under 662, right? Don't forget, well, we're, don't forget subchapter J.
I have a question. Is the $5,000 the second person got with all the other stuff? Can we just extract the $5,000 and say if the $5,000 is specific request and the rest is not?
Yeah, because the will, the terms of the last will and testament will say, I give, devise, and bequeath Shang $5,000. All the rest residuary of my estate, I give to Dean. And it really will say that. I mean, that's what wills do. And Shang got a small little token gift because, I'm dying and I like Shang, but Dane is my BFF. So he's going to get everything, or largely everything. But, so wills are going to do that all the time. All right, everyone's good? Everyone can handle that?
No,
Mariara, you
can
got
we
that?
recap? So the beneficiary is taxed on 9,000.
Yeah.
The residuary beneficiary is not
What?
taxed on 18.
No. Shang is not taxed on anything. He got the specific request. Dane, the residuary beneficiary, gets taxed on $9,000.
Maybe I'm not reading this right.
There's two distributions of
Yeah, this is
$5,000.
really
Yeah.
This is
convoluted.
confusing because
I
I don't
understand,
understand
I
who
know.
The
gets
way
what.
it's
It's
worded
like,
is
it's
confusing.
all
It
over
is-
the place.
It is confusing. I didn't come up with the problem.
Right.
Okay,
Too
so
fast, you forget this.
They should have actually detailed this out a little better.
They should have come up with two different numbers.
Yeah,
Right, they should have
numbers
said-
are almost
Right.
like, you're not reading it and thinking.
One gets $5,000
But,
cash,
listen,
the other gets 7.
I'm living in a glass house trying to come up with my own textbook, so I'm trying to be gentle here, okay?
Can we do this again? The beneficiary is not taxed.
They have names.
Okay, I forgot who was who.
Shang got the 5,000 specific request,
Okay,
and Dane got the residuary.
everything else.
Yep.
Okay. So if Dane got everything else, he's taxed on 9,000.
Yes,
Shang is not taxed on anything.
yeah.
And then there's $11,000 of BNI pending that is taxed to the estate.
Well, just be careful, because what we do, remember, D&I is not necessarily the taxable income, right, of an estate, right? D&I is just a marker. So all we're doing now is saying the trust should compute its taxable income, and it's gonna get a $9,000 distribution deduction, right?
Okay.
I can't ultimately tell you what the estate is gonna be taxed on.
Okay.
All I can tell you is we're trying to figure out what is the distribution deduction and what under 661.
But
That's just
9,000
one number.
stays in the estate. I mean, 11,000 stays in the estate.
Yeah, I mean, if I were a gambler, you're probably not far off, okay? I just don't want to say that kind of word, okay? So go through, make sure you know this. Let's look at question B. Calculate the bases of both the securities and the real estate in the hands of the residuary beneficiary. And I think we know what that basis is, because we just said it, but what's the basis in the real estate, guys? 12, what's our authority for that number, 12,000?
643E.
No. 1014, right? Because it wasn't part of the estate. It was plain vanilla, David would tell you, 1014, right? What's the authority for Dane having a $4,000 basis in the securities?
643.
E what?
E.
E1. In Battleship, you wouldn't win unless you said E1. Simone, you got that?
Can we say that again? I'm sorry.
Yeah. The basis to Dane in the securities is spelled out in code section 643E1.
So it's all carryover,
Yeah.
okay.
Okay, you having fun yet? Let's do 328. Assume the same facts in 327, except the residual rate beneficiary, Dane, you're up at bat again. You're going to receive a car instead of the real estate, and this time it's part of the estate. Excuse me, it's part of the estate. The car is worth 15, and the estate's basis in it is 12. So I'm going to erase the real estate, and I'm going to put the car, and you guys don't say it out loud, let's have some fun here. 12 and 15. Come up with numbers of what Dane should be taxed on. And I said to my class this morning, or this afternoon, 10-year job is at stake like this one.
Is there enough principal?
And we're going to distribute cash. I don't know what you mean by enough principal. In other words, Dane is a residual rate beneficiary. Right? He's a residual rate beneficiary. In other words, we know, Sheng, no offense to you, you're out of the game. You get your $5,000 cash, not taxed. Everyone agree? Sheng's easy, 663, right? Take one more minute. All right, Dane, you feeling lucky?
I can give it a shot.
Okay.
I
And
think,
then Simone and Justin, you see if you agree with Dane. So just tell us, Joe, don't explain it. Just give us a number and then we'll see if your colleagues behind you agree you. If they're behind you, in a good way or a bad way, let's see, metaphorically.
I want to say you're taxed on $20,000.
Okay? Simone,
I would think it would be like the 12,000 plus the 5,000.
so what's Dane's total tax burden?
17,000.
Say 17. Justin? You have a number, Justin?
Don't have a number, no.
Karen, you have a number?
I thought 20 as well.
Javier?
Not sure.
Ming?
21.
21. EK? 17. Young Hung? Say again? 20. Ping? 17. All right, let's just talk about this.
They didn't remove the securities, did they? I mean, just
Yeah,
added the car
securities is
instead.
still there, right?
What is he getting here, guys?
He's getting cash.
He's getting car, cash, and securities, right? Dane's getting all three, right?
They didn't get all three.
So I say 20.
So normally, say again?
Maximum is 20.
Okay.
Oh,
Now,
it's
I know, that's a problem. A lot of people make the mistake and say, gee, he's gonna be taxed on, we know under 643E1, you know, the adjusted basis, right? But we know, don't forget what you learned the last few weeks, you can never be taxed on more than D&I, right? So it's gonna be taxed on 20,000, that's the cap, right? Can't be taxed on more than D&I.
Right.
What's his basis? So the amount he's taxed on is 20,000. What's my authority? 662A2, which says, you know, you can only be taxed up to a maximum of D&I. What's his basis in these assets? Say again, Alicia?
21.
Well, you gotta go asset by asset, you can't just,
12 car, cash 5, and securities 4.
okay. What's your authority?
This will be 643,
643E1, right? (3-29). Would it matter if the residuary beneficiary of problem 3-28 had been entitled to a car under specific rather than a residuary request? So suppose Dane was supposed to get the Porsche as a specific request, as opposed to a residuary request. Okay, everyone had the visual that Dane is gonna get the Porsche, the car, where Sola dies, and I say 5,000 to Shang, Porsche to Dane, and everything else I give to Dane, but I make it a specific request, which can happen. Will that change the tax outcome here?
Yes. Yes.
Simone, you quickly say yes, and if so, why? Just say it loudly. What code section controls?
663?
Okay, so what are the different tax effects to Dane?
I don't know who Dane is, I'm sorry.
Dane is right in front of you.
No,
Oh,
Beneficiary or
it was
residuary?
he's the he's now has two hats on. Dane is getting a specific request and he's getting a residuary request.
The fact that it is a bequest,
Both are requests.
yes. That means that it's non-taxable.
Well, the residuary request, last time, just the last problem, he got taxed on 20,000. Well, pulled out D&I. That prior distribution pulled out 20,000 of D&I, because that's what residuary requests do all the time. In this case, Shane does not get taxed on his $5,000. Dane does not get taxed on the receipt of a Porsche, right? Because sometimes you or your clients will get specific requests, and when they get the car keys, they don't expect a tax liability, right? Everyone agree? When they get the car keys, they don't expect a tax liability, and they're right, because they heard about Code Section 102, they Googled, right? And they find out, oh, I get it. So there's no expectation of tax. But with respect to the residuary request, presumably the estate earned income during the process of administration, 20,000 roughly. We're using D&I as a benchmark there. So Dane will be taxable on
20,000.
not 20,000 this time,
No,
because
no,
the only thing he's being distributed is what? 9. Because the only thing that's being distributed as part of the residuary estate is the securities and cash.
Right.
See, it can change. Young Hung, you got that?
So the car is
The car now is a specific request. It falls within the scope of 663. And to get to B's point, what this means is the estate is going to be bearing a larger tax liability. In the last problem, right, Simone, the estate probably had no tax. Everyone agree? Because it was making a distribution that pulled out all the D&I. In this case, a lot of the D&I is gonna remain embedded in the estate, so on the 1041, it's gonna pay a probably pretty significant tax. Right? Isn't this all of subchapter J designed to just figure out who should be taxed? The estate or the beneficiaries, right? That's what we're here for tonight and every night.
I have a question. Keenan's case doesn't apply to the
There's
clause
no application.
because it's not satisfied with that.
It's
right?
not satisfying debt. You got that, Meg? No application of Keenan here. Three 30. Assume 3-28, except that 10,000 of these states D&I is tax exempt. What was the author's point in bringing that to your attention?
The max is now 10.
The tax exempt is exempt.
On what's D&I? Has D&I changed?
No.
No. So D&I is still 20, but it's comprised of tax exempt and taxable. And the beneficiary, if you recall in that problem, Dane, in our example, was going to be taxed on 20. But remember, under 662, he picks up whatever the character of the D&I is. So he would have $10,000 of taxable income and $10,000 of exempt income. And B, I think to your point, is that on Schedule B, D&I is 20, but the income distribution deduction, the last line on Schedule B, will be 10. And 10, right? You can't get a deduction on the front page of the 1041 for the entire 20. You can only get a $10,000 deduction, right? On the front page of the 1040. Three 31. Assume the same facts as 3-27, except the executor, pursuant to authority granted in the decedent's will, funds the $5,000 general bequest. That's the specific bequest going to Shang. Okay? The $5,000 going to Shang with securities worth $5,000 instead of cash, and the estate's basis in the securities is $4,000. Okay, so on the executor, actually I died. I'm the one who gave it to Shang. So Alicia is the executor, and Alicia's going to give Shang the securities, right? Everyone got that? Shang's going to get the securities. What are the tax consequences? So I got to ask Ming. What are the tax consequences, Ming? This has your name on it. Okay?
Oh, nothing.
What do you mean nothing? There's no tax consequences here?
They don't need it because no tax for the general bequest.
So Shang has no tax. So this distribution has no tax implications. It's a non-event. Shang, do you agree?
Yeah.
Really?
Well, there's capital gain to the estate.
Doesn't the estate have a gain of
Yeah.
1,000.
Yeah,
$1,000?
doesn't it, this is Keenan. What? This is the Keenan case, right, David?
But what throws me here is it's a specific bequest, but how do you get to a debt? You know what I
Well,
like,
because Alicia is the executor, she owes Shang $5,000. Everyone agree? It's the equivalent of a debt. She has a legal obligation to give Shang $5,000.
Okay.
So therefore, she could give him cash. She could sell the securities and get the cash herself.
Right.
Or she's going to give him the securities, but it's treated for tax purposes as if Alicia sold the securities and gave the proceeds to Shang.
So,
Yes, so the
So
trust will
so
pay.
it's
So
not
the
trust.
trust
The
will
estate-
pay.
The
will
same.
have a $1,000 gain.
$1,000 gain, but the beneficiary receives.
Right,
It's not
they won't have a
receiving.
gain, absolutely.
Right,
All right, sorry for any confusion.
okay.
And therefore, what's Shang's basis in these securities?
5,000.
5,000.
5,000.
643E1 does not apply anymore.
Because somebody
Two.
already paid the tax on the gain.
Right, the gain has been taxed. Does it have any other effect? The estate recognizing this $1,000 gain?
Well, the DNI goes up.
V, music to my ears. Say it loudly because it's the perfect mistake.
The DNI goes, oh, that's a mistake.
What code section talks about D&I? 6 what? 643A?
Oh, that's right, oh my gosh.
Yeah, I see Dee raising her hands over her head. The
Okay.
camera isn't capturing that. But what do you
That's
know,
why I'm
Dee?
sitting here. What?
What was your revelation?
Oh, it's capital gain, so of course it's not included in DNI.
D&I does not include generally capital gains, right? But don't worry, B. A lot of people were thinking that. I assure you. Okay?
That seems, makes more sense if it's a trust, but not an estate, because if we're trying to wind this down, right? So,
Well, if it paid out the entirety, then capital gains would be part of D&I, right?
yeah.
If it was the
that's
final
why I
year,
don't
D&I would
confuse
include
the
capital
estate.
gains.
There will be a question on next exam, the same question, I suspect.
Who knows? Who knows?
I'm gonna mark that.
So does that change your answer? Shang still is not taxed, right? Everyone agree? And the D9 does not go up, so therefore the answer would not change. Right? Everyone agree that the answer would not change because D9 is not affected. And then 3-32 says, suggest situations in which a fiduciary might elect to recognize gain under 643E. Again, E3 permits a trustee or an executor to elect to recognize a gain. And truth be told, that's not going to happen. I don't know. I mean, in theory, they could accelerate the gain, but you better, if you're the trustee, you better get all the beneficiaries, the residuary beneficiaries, to agree that they're going to bear the onus. Indirectly, right? The remainder beneficiaries bear the onus of that tax. So I don't know of any situation where I've ever seen an executor or trustee elect to recognize the gain. Maybe if they had an expiring loss, they would make that election, but that's not something that's going to routinely happen. Now, the last revenue ruling, and then we'll take a break, 69-486, talks about two beneficiaries, or each entitled to one half of, like, if Alicia and Edward were beneficiaries, and there is two kinds of assets. Let's just say cash and appreciated securities. And Alicia is in a high tax bracket, and Edward's in a low tax bracket. And Alicia says, let me get the cash, you get the securities, because again, strategically, it would make sense if they could work out that arrangement with the trustee that they're both worth equal amounts, but again, Alicia will take the cash, she's in a higher tax bracket. Edward maybe is a charity or pays no tax, and he doesn't mind getting the appreciated securities. What this revenue ruling says, if you work out those arrangements, it could be considered a de facto sale of Alicia of one half of her interest, right? As if she had sold one half of her interest in the securities to get cash. So read that revenue ruling. You got to be careful if deals are worked out between and among beneficiaries, where they work it out where they're going to get certain assets. Now, guys, when you get back, we have to really tackle the issue of grantor trust. So try to get some caffeine, and we'll see you back here in about 8 minutes.
It's okay.